For years, corporate crypto accounting has been, well, let's just say it's been a total mess. Imagine a world where any gains you made were completely invisible on your financial statements, but any losses were permanent. That's been the reality, and honestly, it's been a huge roadblock for companies wanting to get into crypto. But that's all about to change. The top US accounting rulemaker, FASB, just dropped a landmark update that just might, finally open the floodgates for crypto on corporate balance sheets.
So let's break down what we're going to cover. First, we'll get into the weeds of the big accounting problem and the old, kind of broken model everyone was stuck with. Then, we'll dive into FASB's new fair value solution. After that, we'll see how the US stacks up against international standards, look at the real-world impact on markets, and finally, peek into the future of corporate crypto.
All right, first up, crypto's accounting problem. To really get why this new rule is such a big deal, we've got to understand the problem it's fixing. And believe me, the old way of doing things was a fundamental misfit for crypto.
Seriously, what if your company could only report when an asset's value goes down? Just think about that for a second. Let's say your company buys Bitcoin at $30,000. It shoots up to $60,000, but you can't show that gain on your books. Nope. Then it dips to $55,000 for just one day. Boom! You've got to write it down, and that paper loss, it's permanent. That was the bizarre reality, creating a financial picture that was completely disconnected from what was actually happening.
Now, we're not talking about some tiny niche problem here. This was becoming a massive issue. I mean, just look at this number. In the second quarter of 2023 alone, the number of public companies holding Bitcoin jumped by a whopping 58%. You've got major corporate treasuries adding crypto to their balance sheets. So the pressure to create some sensible modern accounting rules was getting, well, pretty intense.
Okay, let's get into it. Section 2, the old impairment model. This thing was basically a one-way street to frustration. Let's unpack exactly how this, let's call it broken system, actually worked. Or maybe more accurately, how it didn't.
So here's the official definition of the costless impairment model. But what does that really mean? Well, under this model, crypto was bizarrely classified as an indefinite-lived intangible asset. They basically lumped it in the same category as a corporate trademark or a patent. Think about that. So you'd record it at whatever you paid for it. If the price dropped, you had to report a loss, an impairment. But if the price recovered and, went to the moon, too bad, absolutely nothing. Your balance sheet was stuck showing that lower value until the day you sold it. It was wild.
So yeah, you can see how this model just created a ton of problems. It was, like we said, a one-way street that only ever recognized the bad news, and those impairment losses were permanent. This created what accountants call a classification misfit, which is a fancy way of saying it made absolutely no sense to treat a highly liquid asset like Bitcoin the same way you treat a company logo. Not for investors, not for analysts, not for anyone, really.
Okay, enough doom and gloom about the old way. Let's talk about the solution. This brings us to FASB's fair value solution, which is all about reflecting reality. This is where the Financial Accounting Standards Board, that's FASB, finally stepped in to pull crypto accounting into the 21st century.
All right, so the new rule is officially called ASU 2023-08, and at its heart is one simple, powerful idea: fair value. What does that mean? It just means companies now have to measure their crypto at its current market price every single reporting period. But here's the real game changer. The changes in that value, both the gains and the losses, get recorded directly in net income. That is a huge deal.
And this comparison just lays it all out, plain and simple. The difference is night and day. With the old model, you're looking backwards, stuck at the original cost and only ever writing things down. But with the new fair value model, it's dynamic. It's marked to the current market value every single period. We're talking about a monumental shift here, one that gives investors a much clearer and more honest picture of what's really going on.
Now, this change is huge for the US, but it's also really interesting to see how it stacks up globally. So let's compare the new US rules, that's US GAAP, to the international standards, known as IFRS.
And this table really highlights the key differences. First up, measurement. In the US, fair value is now mandatory, no choice. Internationally, though, companies get to pick between the cost model or fair value. But the biggest difference, and you really got to pay attention to this one, is the income impact. The US rules say gains and losses hit your net income, your bottom line directly. But under IFRS, they can stick those changes in something called Other Comprehensive Income, or OCI, which, well, it kind of buffers the main profit and loss number. The takeaway? US companies are about to show a lot more earnings volatility from their crypto holdings.
All right, we've got the new rule. We know how it works. So what? What does this actually change in the real world for companies and for markets? Let's talk about the impact.
And I think this quote from Jonathan Shipman at the University of Arkansas really hits the nail on the head. He's saying that, yeah, the experts agree fair value is a much better way to do things. It just makes more sense. But, and this is a big but, it's not a silver bullet. There are still going to be challenges, especially when it comes to figuring out the value of crypto assets that don't trade as often. That's still something companies will have to figure out.
So really, you can think of this as a double-edged sword. On the plus side, financial statements are about to become way more relevant. Investors can finally see what a company's crypto is actually worth. That's a huge win for transparency. The flip side? Get ready for more volatility. A company's earnings could swing wildly with the price of crypto, and that's a new headache for CFOs. But I think the biggest takeaway, the real story here, is that this could seriously spur adoption. By getting rid of a massive accounting roadblock, FASB might have just rolled out the red carpet for more corporations to get into crypto.
Which brings us perfectly to our final section, the future of corporate crypto. Now that we have this new clarity, what happens next? What's the next frontier?
And this is really the big question, isn't it? With these accounting hurdles finally lowered, are corporate balance sheets the next big frontier for crypto? You have to remember, this isn't just some boring technical update for accountants. This is a powerful signal. It's the highest accounting authority in the country basically saying that crypto is a legitimate asset class. By making the rules make sense, FASB didn't just fix a problem. They might have just unlocked the door for a whole new wave of corporate adoption.
And of course, just a final important reminder, we're here to break things down and provide information. This is not financial advice.